Cryptocurrency is more popular than ever, but not everyone is a fan. There are factions of folks who are constantly foraging for FUD to dissuade individuals and institutions from adopting crypto. One of their favourite points of focus in this regard has to be the effects of Bitcoin mining on the climate, even though the statistics for this have been scant and inconclusive at best. That is, until now. Today, I'm going to tell you about a recent report which assessed exactly how much of an effect Bitcoin mining is having on the climate and what its findings mean for BTC. I hate to hit pause, but I need to hit you with a clause. I can't give you any financial advice because that would be against the law. I can only give you facts and stats that will leave you in awe. Please contact a financial advisor if your wallet is looking raw. If this is your first time tuning in, my name is Guy and some call me the Crypto Info King. That's because I create high-quality crypto content about many things. Coins, tokens, news, reviews, and other crypto-related stuff that's occurring. If you value brains over bling, subscribe to the channel and give that notification bell a ping. If time is short, you can use the timestamps below to skip ahead and come back when you're bored. Just know that watching until the end is the best way to give the Coin Bureau support. Now that I've protected myself from ending up in court, let's check out this Bitcoin mining report. The crypto report I'll be covering today was written by CoinShares. CoinShares is a crypto company based here in London which provides an array of crypto services geared towards institutional investors. This includes exchange-traded products for cryptocurrencies, venture capital allocation for upcoming crypto projects, and crypto investment risk management. CoinShares has been around since 2013 and was actually the first company to get an exchange-traded product for crypto approved in 2015 with its Bitcoin Tracker 1 ETN. CoinShares is also a publicly traded company which listed around the same time as Coinbase last year, and CoinShares currently has a market cap of around $5 billion. Not only that, but the CoinShares logo is literally an astronaut, underscoring the company's belief that crypto is going to the moon. Like many other crypto companies, CoinShares regularly publishes reports and insights about the crypto market, which can be found on its website under the Learn tab and its Medium page. Now, the CoinShares report I'll be covering today is titled, quote, The Bitcoin Mining Network, Energy and Carbon Impact. And a bit of background is required before I dig in. CoinShares notes that it released this report as a sort of response to ESG concerns from institutional investors which emerged last year. For those unfamiliar, ESG stands for Environmental, Social, Governance, and it's the template institutional investors have been using to allocate their capital, primarily large asset managers such as BlackRock. It's believed that institutional concerns around Bitcoin mining on the E factor are what crashed the crypto market in May of last year, and you can learn more about that by using the link in the description. So, with that out of the way, let's dig in. CoinShares' Bitcoin mining report begins with a brief history of the concerns about the energy used by Bitcoin mining. This includes a famous response from Bitcoin creator Satoshi Nakamoto, who was already dealing with energy critics way back in 2010. Quote, The utility of the exchanges made possible by Bitcoin will far exceed the cost of electricity used. Therefore, not having Bitcoin would be the net waste. The authors specify that they are on the same page as Satoshi, and this is basically because the economic incentive to spend being caused by the constant inflation of fiat is wasting a lot more energy than Bitcoin mining, and it's destroying the environment. The authors also point out that concerns about Bitcoin mining only emerge when the crypto market is hot, and the same, quote, sensationalist commentators essentially share these recycled concerns for clicks. While the Bitcoin community has historically responded with facts and stats, quote, much of the debate surrounding this issue tends to be based on qualitative and anecdotal evidence, with rare and mostly cursory attempts to directly quantify the emissions themselves. In other words, there isn't detailed data that definitively supports either side of the debate, and this is what the authors want to change. Quote, To address this, we've developed a comprehensive model to calculate emissions and created our own data collection framework to populate it. The authors also mention that they will be open sourcing the model they used as well as the data they used so that crypto critics and supporters alike can play around to see what it says about Bitcoin mining. The second part of the Bitcoin mining report lays out the methodology the authors used to measure the carbon emissions created by Bitcoin mining. They start by making an important point, and that's, quote, Bitcoin, like electric cars, is as green as the electricity you feed it, meaning that in a 100% renewable energy environment, Bitcoin would be 100% renewables driven. Next, the authors break down the three components in their methodology. These are calculating network efficiency, calculating carbon emissions, and a whole bunch of assumptions. In terms of network efficiency, the authors examined the energy profile of every single Bitcoin mining machine ever made and estimated how prevalent they are in Bitcoin mining operations today, as well as how prevalent they're likely to be going forward. This is in contrast to what the authors refer to as the, quote, top-down method, which is to choose a single Bitcoin mining machine, assume every Bitcoin miner out there is using that one type of machine, and calculate energy use based on that assumption. With their more accurate estimate of the energy use of Bitcoin mining machines, the authors then estimated the total energy use by looking at the hash rate of the entire Bitcoin blockchain. When it comes to calculating carbon emissions, the authors looked at the different regions where Bitcoin miners are based and how those regions get their power. Logically, if a region is getting 100% of its power from fossil fuels, then it's safe to assume that any Bitcoin mining operations in that region are using those same energy sources. Now, as for the assumptions, the authors make 7. The first is that they use a combination of their own internal data and publicly available data to estimate the current composition of crypto mining machines and ignore the variations within the same kinds of crypto mining machines during their production lifetime. The second is that they use complex calculations to determine how many of these Bitcoin mining machines in circulation are turned on at any given time, and assume the majority of these will be the most efficient mining machines since they are the most profitable. The authors also make a prediction that the least efficient mining machines will cluster in regions where energy is cheapest. The third assumption is that the implied hash rate of the entire Bitcoin blockchain is correct, which is hard to say for sure. The fourth is that they use a combination of publicly available data about the regions where Bitcoin mining operations are most based and estimate how much energy the mining operations in those regions are using. What's interesting is that the authors say they're skeptical of the official statistics, which show that there's no Bitcoin mining going on in China, and therefore initially assigned around 9% of Bitcoin's current hash rate to the region. The fifth assumption is that Bitcoin miners are using the same combination of energy sources as the regions in which they're based, which may not be the case given that miners gravitate towards the cheapest energy sources. The sixth is that Bitcoin mining operations use 10% more energy on other stuff besides mining, such as cooling the mining machines. And the final assumption involves a series of calculations about the carbon emissions of fossil fuel-based energy sources, namely oil field mining. And speaking of energy, have you ever wondered what effect all of these energy shortages could have on crypto mining? If you have, you might be interested in the link in the description. Anyways, the third part of the Bitcoin mining report reveals the results of the author's methodology. For starters, the authors found that older Bitcoin mining machines are being phased out in favor of newer, more energy-efficient models. Although the total carbon emissions of Bitcoin mining are trending up over time, the carbon emissions per unit of energy are also declining due to more efficient equipment. As far as the authors can tell, most Bitcoin mining is being done with the Antminer S19, with the Antminer S9 in second place, and the WattsMiner M30 in third place. The authors are amazed by this fact because the Antminer S9 was first released way back in 2016. As such, they state, quote, "This clearly demonstrates the current profitability levels of mining and the longevity of well-built mining hardware. Even so, the authors found that less efficient Bitcoin miners tend to come online when the price of BTC goes up, since it becomes more profitable for them to mine. This actually resulted in a slight decrease in total energy efficiency in 2021. One of the most important results is Bitcoin's total energy use, which has been a highly sought-after statistic by interests on both sides of the debate. Quote, the Bitcoin mining network uses approximately 0.05% of the total energy consumed globally. This strikes us as a small cost for a global monetary system, and on the global energy balance sheet, it amounts to a rounding error. The authors then take some time to unpack how Bitcoin's energy use is distributed across different regions. As most of you will know, the United States took the crypto mining crown from China and currently accounts for the largest slice of the energy pie at around 42%. Kazakhstan, of course, comes in second place at 22%, and Canada is third with 11.5%. After crunching the numbers, the authors also found that China currently generates about 7% of Bitcoin's hash rate, despite the country's crypto ban. Now, the last set of results relate to the carbon emissions associated with Bitcoin mining, and it starts with the statistic that made crypto news headlines. According to the author's analysis, the carbon emissions associated with Bitcoin mining account for, quote, less than 0.08% or less than 1/1000th of the global total. To put things into context, this is only around 4x more than the carbon emitted to just create fiat currencies. It's less than a third of the carbon emitted by the gold industry, almost less than a third of the carbon emitted by the global banking system, and slightly less than the carbon emissions of dryers each year. Yeah, dryers, the things you use to dry your clothes in. Now, these comparisons are in stark contrast to the comparisons you see in clickbait headlines about crypto mining and the climate, and you can learn more about why those are all BS by clicking the link in the description. Anyhow, the authors then break down the energy sources being used by Bitcoin mining that are generating this minuscule amount of carbon. Quote, coal currently produces almost all of the emissions at 76%, with gas and oil in distant second and third place, currently emitting 21% and 3% respectively. What's crazy is that, quote, our calculations suggest that the migration of mining out of China temporarily increased the annual average carbon intensity of mining. This is somewhat contrary to the commonly held belief that Bitcoin mining got greener when all operations supposedly left China, though December data suggests this is now the case. More importantly, the carbon intensity of Bitcoin mining has been declining over time. The authors also believe the decline in carbon emissions will be more aggressive in the Bitcoin mining industry due to the mobility of miners and their incentive to seek out the cheapest energy sources, which are almost always renewable. What's ironic is that the biggest chunk of Bitcoin's carbon emissions is coming from within the United States, and this is more so a consequence of the energy composition of the country than the actions of, say, that one crypto mining company that bought a coal plant. On that note, quote, as of December 2021, we estimate the relative contributions of coal, gas, hydro, nuclear and wind at 35%, 24%, 21%, 11% and 4% respectively. The remaining generation of 5% is a mixture of small amounts of oil, solar and other renewables, mainly geothermal. This means that more than a third of Bitcoin's energy comes from renewable energy sources, which is amazing, but probably not enough for Tesla to accept BTC as payment again. Yet. You can learn more about these kinds of bullish upcoming crypto milestones by watching my video about that using the link in the description. I digress. The fourth part of the Bitcoin mining report discusses the results as well as any factors to take into consideration. First, quote, overall, our findings are broadly in line with recent comprehensive work on the topic, which verifies the general validity of their methodology. The authors then speculate on the possibility that we will continue to see significant improvements in mining machine efficiency for decades to come, which will further reduce energy consumption and also carbon emissions as mining operations shift to renewable energy, particularly hydro. Quote, because electricity is not easily transported over long distances, and the marginal cost of hydroelectricity is extremely low, hydropower in locations that are geographically separated from large centres of demand is often some of the cheapest electricity in the world. The authors therefore argue that Bitcoin mining could be the perfect way to bootstrap these kinds of renewable energy sources by increasing their profits in the absence of immediate demand. Next, the authors point out that the best way to minimize Bitcoin mining emissions is for Western governments to create policy that attracts them to regions that use more renewable energy. This is because banning Bitcoin mining entirely would just result in mining operations locating to regions which use fossil fuels as their primary energy source. As far as the authors are concerned, the only reason why Bitcoin miners are in those regions right now is because the governments there provide massive subsidies to fossil fuel companies, which makes dirty energy artificially cheaper than clean energy. The authors then pivot to an interesting possibility, and that's whether it would be financially feasible to offset Bitcoin's existing carbon emissions through the purchase of carbon credits. Now, for those unfamiliar, carbon credits are essentially certificates given to companies by government authorities when they do something green, such as add a solar panel to their facilities. Oddly enough, carbon credits can be traded, and they're often purchased by companies that produce emissions to avoid any emission sanctions, since one carbon credit gives its holder the right to emit 1 ton of carbon dioxide. Fun fact, Tesla makes most of its money from selling the carbon credits it receives. Carbon credits are an interesting idea, to say the least. In any case, the authors crunched the numbers and determined that the carbon output of Bitcoin mining could be offset at a cost of, wait for it, $200 per BTC. This works out to less than 0.5% of Bitcoin mining revenue, assuming an average price of 42k per BTC, but it could be a bigger cut if we enter a crypto winter. More about that in the description. The fifth and final part of the Bitcoin mining report is the conclusion, and the authors come in guns a-blazing. Quote, at 0.08% of global CO2e emissions, removing the entire mining network from global demand, and thereby depriving hundreds of millions of people of their only hope for a fair and accessible form of money, would not amount to anything more than a rounding error. However, quote, in order to provide its combined services of open, peer-to-peer, objective, censorship-resistant, and trust-minimized participation in a global monetary network, Bitcoin strictly requires a non-zero amount of input energy in perpetuity. The future magnitude of this requirement is unknown. Put simply, the authors acknowledge that the energy required to maintain the Bitcoin blockchain will continue to increase indefinitely until the last BTC is mined. More about that with the video in the top right. Now, the authors note Bitcoin's future energy use is irrelevant because almost every other industry will require more energy in the future as well. What's important is that this energy use doesn't involve any fossil fuels, to which the authors say, quote, Bitcoin will be 100% renewable as soon as our electricity generation is 100% renewable. They then conclude the report with, quote, when analysed over the long term and in proper context, we believe that the emission costs of Bitcoin are dwarfed by its benefits. And I couldn't agree more. People tend to forget that Bitcoin is more than BTC. Bitcoin is technically the most secure payment network on the planet. That's because it's the most decentralized. This security is made possible by the proof-of-work consensus mechanism, and the authors even mentioned this at the beginning of the paper. Besides making BTC the ideal currency to hold, this makes Bitcoin the perfect blockchain to build the future of the financial system on. Some crypto projects such as Stacks are building a smart contract-compatible Layer 2, whereas others such as the Lightning Network are building seriously scalable payment systems. As it so happens, institutional investors value security more than anything else, and one of the only things standing in the way of them and BTC are their environmental concerns, which will hopefully be quelled as this groundbreaking report makes the rounds. I'm quite confident that this will happen, and that's because of what I heard at the recent hearing about cryptocurrency mining hosted by high-ranking politicians in the United States. You can find out what they said by using the link in the description. And that's all for today's video about CoinShares Bitcoin mining report. Be sure to share it with someone you think needs to see it and smash that like button if you enjoyed it. Remember to subscribe to the channel and ping that notification bell before you go because there's lots more to come from the Coin Bureau. This isn't the only place you can find me either. I post frequently on Coin Bureau clips where you can peek behind the scenes and also see my live streams. I'm also active on Twitter, Instagram and TikTok where I share the kind of crypto wisdom you need. I even have a Telegram channel where I give you in-depth crypto market updates on the daily. If you prefer emails, I have a newsletter too. It contains a detailed breakdown of my personal crypto portfolio, as well as useful tools, tips and tricks just for you. Last but not least, there's the Coin Bureau merch store, which currently has a promo for Valentine's Day. Buy 2 items and get 25% off. The promo expires on February the 14th, so be quick. So you can find your way there and to all the other resources I just mentioned using the links in the description. Thank you as always for watching. I hope you all have a fantastic day or night, and I'll see you all soon, so sit tight. This is Guy bidding you goodbye.